The most dangerous lie in modern finance is that nations act to maximize profit. They don't. They act to maximize survival. If you were looking at the stock market to understand the health of the economy, you are looking at a mirage. The real story is happening in the plumbing of the global bond market, where a specific number has just flashed red: $682.6 billion. This is not just a statistic on a Bloomberg terminal. It is the sound of the tectonic plates of the global order snapping apart. For the first time in nearly 2 decades, China's holdings of U.S. government debt have collapsed to a level that signals a total strategic retreat. Beijing is no longer just rebalancing a portfolio. They are executing a scorched earth exit from the American financial system. What makes this move terrifying for the US Treasury isn't just the volume of the sale, it is the price. China is dumping these bonds at a staggering loss. They are selling assets for cents on the dollar, locking in billions in realized losses that would get any Wall Street fund manager fired instantly. To the untrained eye, this looks like financial suicide. But this is not a financial decision. It is a geopolitical divorce settlement. Beijing has calculated that paying a massive exit fee now is cheaper than having their entire wealth confiscated later. They are looking at the $300 billion in Russian assets frozen by the West and realizing that, in the event of a conflict, their trillion-dollar insurance policy is actually a liability. The implications of this fire sale are already rippling through the wallet of every American citizen. The bond market operates on a simple seesaw. When the world's biggest lender stops lending and starts selling, the price of bonds crashes and the interest rate or yield skyrockets. This is why the 30-year fixed mortgage is becoming a luxury item. This is why auto loans are hitting predatory levels. It is not just the Federal Reserve raising rates, it is the primary engine of global liquidity shutting down. When China walks away, the cost of borrowing for the US government, and by proxy, the US taxpayer, begins a permanent climb upward. For decades, the arrangement was simple. Americans bought cheap goods, and China recycled those dollars back into US debt, keeping interest rates artificially low. That cycle is dead. The stockpile of US Treasuries held by China has been sliced in half from its 2013 peak. The velocity of this exit has accelerated violently over the last 12 months, creating a liquidity vacuum that domestic buyers cannot fill. We are witnessing the end of the exorbitant privilege where the US could print endless money because there was always a buyer for the debt. Now the buyer is gone and the debt remains. But the capital leaving the US isn't vanishing, it is mutating. While the official data shows a massive drop, we are seeing a suspicious surge in holdings within custodial hubs like Belgium and Luxembourg. This suggests a game of financial hide-and-seek, moving assets into shadow reserves to create a buffer against sanctions. More importantly, the paper dollars are being transmuted into hard assets. For 14 consecutive months, the People's Bank of China has been relentlessly acquiring gold, swapping digital promises from Washington for physical bars in Shanghai. They are moving from a system based on credit to a system based on collateral. This transition to hard assets coincides with the rise of a new parallel infrastructure. The launch of the unit, a transactional system backed partially by gold, allows the BRICS nations to settle trade without ever touching the US banking system. This is the nightmare scenario for the dollar. If oil, minerals, and manufactured goods can be traded outside a SWIFT network, the structural demand for the US dollar evaporates. Without that demand, the inflation that the US has successfully exported to the rest of the world for 50 years will come flooding back home. The danger for the American banking system cannot be overstated. We are facing a duration risk crisis. As China dumps long-term 10-year and 30-year bonds, the value of those bonds plummets. U.S. regional banks, which hold trillions of these securities as safe assets, are sitting on massive unrealized losses. It is the same mechanic that triggered the banking failures of 2023, but on a much larger scale. If the sell-off continues, the Federal Reserve will be forced into a corner. They will have to choose between letting the banking system collapse or printing trillions of dollars to buy the bonds that China refuses to hold. This is the mechanism of the death spiral. If the Fed steps in as the buyer of last resort, the money supply expands and the purchasing power of the currency dilutes. It is a direct causal chain. Beijing sells the debt, the Fed prints to cover the exit, and the price of groceries in Ohio doubles. We are moving from an era of cheap capital and low inflation to an era of scarce capital and sticky inflation. The dollar smile theory is breaking. Usually, the dollar strengthens in a crisis, but when the crisis is a loss of trust in the dollar itself, the currency has nowhere to hide. The $688 billion figure is a warning shot. It signifies that the era of mutual assured economic destruction is over. China is willing to burn its savings to achieve sovereignty. signaling they are preparing for a world where trade is fragmented and dangerous. For the individual investor, the message is clear. The risk-free rate is no longer risk-free. The volatility of the bond market is a symptom of a global order that is fracturing. In this new landscape, liquidity is drying up, and the only safety lies in assets that cannot be printed, sanctioned, or devalued by a central bank desperate to keep the lights on.